Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's worked in the oil industry for over 30 years. He's a former senior executive at Hess Oil, and he also runs the Energy Prospectus Group. Dan Steffens, thank you for joining me again.
Yeah, glad to be back.
So, Dan, we're recording this interview on Monday, July 3rd, 2023. West Texas Intermediate crude oil prices have been down substantially the last few months. They're barely just below $70 a barrel when we're recording this interview. Natural gas prices, U.S. natural gas prices were weak for many, many months, but they've had a nice rally the last couple of weeks up to 2.7. But I want to get your thoughts on the U.S. rig count as a leading economic indicator. I've been tracking this with charts over on Y charts. The rig count is down over 14% since the November 2022 high. So what do you think that means for future oil supply?
Well, almost all of that decline in the active rig count is private upstream companies cutting back because they're running out of high quality drilling inventory. The public companies that I follow and the majors, they're down a little bit, maybe, 5-10 rigs total among them. They're pretty much stuck to their drilling programs, but it's all the private companies. But it does tell you that the tier one acreage in these plays and even in the Permian Basin is limited. The Bakken's on decline, the Eagle Ford's on decline. So the only place that really has any significant amount of production upside is the Permian Basin, which is why 50% of the drilling rigs that are active today in the United States are working in the Permian Basin.
Do you think also that the rig count is down, and you mentioned the private companies, is this because of cost of capital too, because of the Fed rate hikes? So the cost of capital is no longer nearly as cheap as it was even 12, 18 months ago.
Yeah, that definitely is part of it. And the reason is the companies that I follow, the public companies, they're not just drill, baby, drill anymore. They are very focused on cleaning up their balance sheets. They did a great job cleaning up balance sheets last year, but they're still focused on paying off debt. Any of them that have these credit lines that are tied to variable interest rates, which most of them are, they want to pay that off because they want to get rid of that interest expense if they can. So they're allocating anywhere from 25 to 50% of their free cash flow to still paying down debt.
Yeah. And the other thing that the companies can do with the free cash flow is also target acquisitions with evaluations. We'll talk about that a little later in the interview. The other thing I wanted to bring up, though, was the drilled but uncompleted wells. So there was a really good article on this a couple of months ago on oilprice.com, which is the best free oil natural gas research website. And the guy went through all the data, all the statistical data, and he showed that a lot of these drilled but uncompleted wells that were available, and I think there was almost 4,000 of them in 2020 and 2021. The oil industry in the Permian has gone through all these wells, and now these wells are depleted.
Yeah, the drilled but uncompleted well inventory probably had almost 2,000 really good uncompleted wells sitting in the inventory. So last year in 2022, we actually completed about 200 wells at the beginning of the year, 200 wells per month, more than we were drilling. And then that kind of went down. And then when we got to 2023, we're just completing about the same number of wells that we're drilling. There's a lot of, I call them dead ducks. They're wells that are in the duck inventory, but they're never going to be completed. They're just only if the oil price jumped over $100 a barrel, maybe some of them would be economic then, but there's a lot of sub-economic wells based on their logs that are sitting in the duck inventory right now.
So would you consider the U.S. rig count as a leading indicator for oil supply and maybe a reversal in the market? So if there's a large downtrend in the rig count, that means then that potentially a lot of supply is going to be offline soon, and we could be reaching a bottom in oil prices.
Yeah, if you've been watching the weekly EIA reports, the U.S. oil production has actually declined about 200,000 barrels per day just in June. U.S. oil production, black oil production, is back to where it was in August of 2022. So we've lost the pace. What's really controlling this is the number of frac crews working has also declined in addition to the drilling rigs. And some companies now, especially the natural gas companies, they are drilling but not completing their gas wells. They're putting those in inventory now. So we're actually completing less wells than we're drilling right now.
And aren't a good amount of the wells, and I interviewed Christine Guerrero a month ago, who's also worked in the oil and natural gas industry for over a decade. And she was saying how a lot of these Permian wells, they have a very high percentage mix of natural gas. So as the natural gas price was collapsing, as the Fed was raising interest rates, this was really hurting the ability of a lot of these Permian oil and natural gas producers who needed that extra revenue from natural gas while it was falling. And then the higher interest rates. So that's kind of basically no incentive then for these producers to bring on new wells.
Well, and in the Permian, I mean, they're drilling for oil. So if they get associated gas, and they'll basically sell it for nothing because they want to be able to produce those wells. They don't want to flare the gas. They're kind of forbidden to flare the gas for very long at all now. But there isn't enough pipeline takeaway capacity. So there's a big discount on the gas coming out of West Texas, especially out of the Delaware Basin, which is the western half of the Permian. Those gas is selling for, $1.50 or something out there because of the differential. If we had more pipeline capacity in the Permian, the gas price would even be lower probably.
So recently, we've had reports come out from both Rystad Energy, which is well respected in the industry, and also I think Raymond James, which also covers oil and natural gas. And they've been predicting a oil and natural gas rally later in the year based on supply and demand fundamentals. I guess supply coming offline and demand either staying at these levels or increasing. Do you expect those reports to be accurate later in the year?
Yeah, I do. I think demand for oil-based products is going to exceed supply by about 2 to 2.5 million barrels per day in the third quarter. Some of that is when all the OPEC plus quota adjustments go into play, which they are now. Starting July 1st, Saudi Arabia has taken another 1 million barrels a day offline. And then there's a seasonal increase in demand for oil because it takes more oil, takes more actual crude oil to make summer blend gasolines. And you just have a higher demand for transportation fuels in the summer in the entire northern hemisphere. So just that difference is going to create a shortage of over 2 million barrels a day in the third quarter. And I think we will see a steady decline in above ground inventories around the world. Last week, EIA reported a 9.6 million barrel decrease in U.S. inventories. And another thing to remember, they have still been Team Biden has still been pulling oil out of the Strategic Petroleum Reserve during June. And that should have ended at the end of June. So what you see reported a lot of times in the news is commercial inventories, and those include the oil coming from the Strategic Petroleum Reserve. I looked at total U.S. oil reserves, and over the last 2 years since Biden's been in office, our total petroleum reserves have declined by almost 25%. So we've gone from like 2.1 billion barrels of oil and refined products to like 1.6 billion barrels.
Do you have the break-even cost for U.S. oil producers, say maybe outside the Permian Basin, around $60 a barrel for drilling new wells? So we're at a price, we're just under $70 a barrel. I mean, if the oil price goes another $5 or $10 a barrel lower, don't you see even more supply coming offline than each $5 or $10 a barrel lower we go?
Oh, yeah, that would happen. And because you're not going to see anybody increasing their drilling budget, and then probably some of them would stop completing wells. But, they're like oil's sitting today on July 3rd, I think right at $70 a barrel. They're still very profitable at $70 a barrel. And they're getting a little boost they didn't expect from, the natural gas price has gained about 50 cents in the last 6 weeks or so. That's given a little boost. That's thanks to the tremendous heat we're having down here in Texas now that's eating up a lot of gas for generating electricity.
Now, the narrative out there, so for the short-term traders, the hedge fund managers, the large portfolio managers, a lot of these guys they're short-term oriented. They're focused on each week, each month, each quarter, trading profits, but they're very heavily net short oil futures contracts. A lot of them expect much lower prices. The narrative there is deflation, bankruptcy, global oil demand is going to keep falling. Do you think that this narrative is true, or do you think that it's a way overcrowded trade?
No, I think it's a way overcrowded trade. And I think there's a very false paradigm. And one thing I'm seeing on our chat board is some people are misinterpreting these OPEC cuts, these Saudi additional supply cuts. I think there's two reasons Saudi do. Number one, Saudi Arabia wants to defend the oil price, and they want to push the Brent oil price up into the 80s again for sure. They need at least $80 Brent to balance their budget. And it's foolish for them. Why sell more oil and get less money? They can sell less oil and get the same amount of money. So why not do that? Leave their reserves in the ground. And plus, they need to rest their fields. They've been pulling some of these fields, and a lot of them are water floods. They've been pulling them pretty hard. I think they need to rest those fields, and they want to set some inventory back so that they can, when demand really does pick up as we move through the third quarter, they can keep their clients. I mean, think of it as a business. They don't want to lose clients because they don't have inventory. So they're trying to adjust that. But I also think the Russian oil is going to slow down that supply eventually, because a whole bunch of the oil field service companies have pulled out of Russia. So sooner or later, you're going to see damage to their fields or stuff they can't fix in the field, and that'll affect their price. But I looked at a Raymond James report, and they're still not considering much Russian oil coming offline. They do say it could. Their estimate 6-8 months ago was that about 500,000 barrels a day would be offline by now, but they've kind of just taken that out of their guesswork at this point.
And that Rystad report we talked about a couple minutes ago, it's actually predicting around $90 a barrel by the end of the year with this rally.
Yeah, I agree with that. I think that's where it should be. I think the only thing that is holding back oil prices is the fear of recession. And I honestly think, I posted an article to our chat board today that when you break it down by individual sectors, we've had individual sectors already go through a recession. Let's say for housing, residential housing, it went through a pretty significant recession, but it's starting to come back, and demand for houses is picking up again. There's all this concern about commercial real estate and everything like that, but there's individual sectors that are now picking up. And I personally believe that you just really can't have a severe recession if you have full employment. And it's pretty much where anybody that wants a job can get a job at this point. So, I mean, think about it. When I see pictures of the Depression, there was a bunch of unemployed people. Well, we don't have that situation today, and our economy runs based on consumer spending. As long as people have jobs, they're going to be spending that money. So,
are people still traveling? So there's still enormous demand for jet fuel and things like that. Because I know China was trying to bring back their air travel, and it wasn't going smoothly. But I believe air travel here in the United States, actually, there was a pretty high spike in it over the last 6 months.
Every time I get on a plane, every seat's full. So I don't know. I think they've been having some delays because of that Canadian forest fire smoke up in the east, maybe, and they've been having some weather up there. But I every time I go through the airport, it seems like there's a heck of a lot of people waiting to get on planes. So that's up. I have seen that in China, internal air traffic has come back, but not their international air traffic has not come back as fast as they thought. So that's a big part of it is aviation fuel demand.
There was also a report out in March, I believe, on the March data at least, that global oil's demand had actually hit an all-time high. So even though China hadn't fully come back online, there had been so much demand increases from other countries like India and other emerging market countries that had offset the slower recovery in China.
Yeah, we're back at overall demand for oil-based products higher than we were pre-pandemic. And the overall thing is we've spent $5 trillion on renewable energy programs over the last 2 decades. If you go back to 2020, probably about $1 trillion just in the last year or so. And fossil fuel demand has not gone down. It hasn't gone down at all. It's actually gone up. So renewables have increased their percentage of the total demand pie, but the the demand keeps growing. Overall demand for energy just keeps going up, up, up. I mean, IEA and EIA, they both forecast that total primary energy will have to increase by 50% from 2020 to 2090 or 2050 over that 30-year period. And yeah, wind and solar may have 7%, but that's, not going to lower oil demand.
Well, also, I think what the average person doesn't understand is a lot of these electric vehicles, a lot of them are for mostly rich people. So if you're
right.
If you're in an emerging market country and you've saved up enough money to go and buy some type of vehicle, normally the first vehicles purchased, say in Vietnam or in India, they're a scooter, they're a motorcycle. So they're going to consume diesel or they're going to consume gasoline. And people aren't looking at buying electric vehicles or hybrids. They're looking at, can I move more efficiently with some type of fuel consumption?
Yeah, I just bought a new car for my wife about 6 weeks ago. When we were in their buying a car, they had two very cool looking electric vehicles sitting in the showroom. And when I looked at both of them compared to the internal combustion vehicles that were of about the same quality, the electric vehicles were like $8,000 to $10,000 higher. And I asked the salesman, I said, "Are you selling many of these electric vehicles?" He said, "No." He goes, people look at them, they want to test drive one, but he goes, they're not buying them.
Well, that's Texas, though. I mean, like in a Democrat state, it's probably different, but then there's a problem with charging stations here. So
right. Yeah, you still got to replace that infrastructure. I mean, we have like 400,000 gasoline filling stations around the country now. Because you can refill a gasoline powered car in like 5 minutes, right? But to recharge a Tesla or something, you got to sit there for 30 minutes minimum to recharge it. So
that's if there's not a 3 hour. Yeah, there's videos of this online, Dan. I don't know if you've seen it. There's like 3 hour lines. It's at the Tesla supercharger.
I know. So you're going to have to build 1 million recharging stations, and I don't think our power grid can handle it.
Our power grid's a joke.
Yeah, power grid's a joke. We're already having like threatened rolling brownouts down here because we're hitting 100 degrees every day. So they're begging people to, put their thermostats up to 80 degrees in the afternoon. Well, I don't think many people are doing it, but I think we're coming very close to maxing out our capacity. You got to love it in Houston. I'm down in Houston, and the weather guy says, we got a little cool front coming, and tomorrow the high is going to be 94. When you call a 94 a cool front, you're in Texas, I guess.
And you guys wouldn't survive without air conditioning. I mean, it's way too hot down there in the summer.
Yeah, you can't.
Yeah, I was explaining this to a friend that 100 years ago, I mean, people in Texas and Florida and other southern states, old people and disabled people, young children died during the summer or in the winter because it was too hot or too cold. So without heating and air conditioning, I mean, you can't really. A lot of people wouldn't survive the hot summers or the winters.
No doubt about it. You had a lot more weather related deaths pre-air conditioning for sure. And when I grew up in St. Louis in the 60s, we finally got a window air conditioner when I was in high school, I think. You just live with it. You lay there and sweat at night with your little fan on. That's it.
Doesn't Texas have a decent amount of wind turbines there? But I'm sure they're not super reliable, so they probably still have to build natural gas power plants for baseload.
Well, what's happened over the last 2 weeks, we had this big high pressure dome, they called it, sitting over the state. We had almost no wind. So the wind generation just went down to nothing. And so they have to fire up every one of these natural gas fired, we call them peaking plants. They sit idle a lot of times, but now they're all running 24/7. They used to, even on hot days, would only run like in the afternoon or something like that. Now they're all running 24/7. We finally have had a little bit change in the weather pattern. At least we're getting some cloudiness, a little rain around the area now. But we had like 3 weeks of really hot and no air movement.
I want to ask you about low-cost oil producers, because in this environment, maybe in the short term, oil prices go down a little bit, but then more supply comes offline and then we get a bottom. Because I think the rig count's still in a downtrend. Because people ask me about the rig count. I think the rig count's a leading indicator, and it's about the trend of the rig count. Is the rig count trending down? Is the rig count trending up? And so if the rig count's trending down, then that means that eventually a lot of supply is going to come offline, and then we're going to hit a bottom, and then we're going to have some type of a rally. But who are the low-cost oil producers that you cover that can actually make money even if oil prices go down substantially?
Well, I mean, all the ones I follow, they're generating profits, and they're going to be profitable in the second quarter. One company I really like is Earthstone Energy. They just announced a very significant deal, a $1.5 billion acquisition. It's going to push their production up to about 135,000 barrels a day. I mean, a year ago, they were at about 25,000 barrels a day. So they've closed a multiple of transactions. It's a good one. Matador Resources is a low-cost producer. I like Permian Resources. That's PR symbol. They're real good. But again, they're all going to be profitable. Let me bring.
Do these companies have a lot of debt on the balance sheet, or do they hedge?
Yeah, some of them hedge quite a bit, so they're in pretty good shape. Well, I was going to look at one of them here. Yeah, I like Callon Petroleum. I'm predicting it reported $3.58 profit in the first quarter, and I got them at almost $2 in the second quarter. Quite profitable. Earthstone also. Let's see. EOG, of course, is one of the best low-cost oil producers. I think they say they've got wells that are profitable down to $40 barrel. Let's see. Again, Matador's good. Northern Oil and Gas. Yep. SM Energy looks pretty good now. They're actually their second quarter results should be very close to their first quarter, and they reported $1.65 cash earnings per share in the first quarter.
So then costs are nowhere near the current West Texas Intermediate price, or is that because of the hedging programs of these companies?
No, and sometimes when you say what's the break-even cost, remember this is to still have operating cash flows, not including recovering your drilling costs. Now, these are expensive wells, these horizontal wells. So you might need, $55, $60 barrel to break even, like to get the well totally paid off in 3 years and everything. But when you're talking about, if I shut down all my drilling and I just produce the current wells, you'd probably be cash flow positive down to $30. Their operating expenses for these companies, and I'm talking, direct operating expenses, production taxes, gathering and processing, G&A, even their interest expense is probably below $25 for almost every company I follow.
So I want to talk now about mergers and acquisitions in the space, because some of the companies, their cost of capital is going to be higher. They're focusing, like you said earlier in the interview, paying off debt on the balance sheet with the free cash flow they have. But also, if they do have free cash flow, maybe instead of paying dividends, they can look at valuations, because the valuations, I would argue that the oil and energy sector has the cheapest valuations of any of the sectors in the S&P 500. Recently, we had One Oak, which is a oil and natural gas services company, I think in Oklahoma. They bought a pipeline company. Are you surprised that there's not more mergers and acquisitions yet?
Yeah, I really like that deal, by the way. That's one of my favorite midstream companies. They're in their high yield income portfolio, and they are merging with Magellan. They're both based in Tulsa. It makes a lot of sense. And One Oak was primarily an NGL company, natural gas liquids and natural gas. And Magellan has more crude oil pipeline gathering storage facilities. So it gives them a much more balanced portfolio. I really like that deal. And if you're investing for dividends, that looks good. And based on my forecast, they're going to be raising their dividend pretty steadily after this deal closes. Yeah, it looks good. Now, and the merger and acquisition stuff, what I've seen lately is the public companies taking over private companies. I mentioned Earthstone. They're closing that a $1.5 billion deal, and then they're immediately selling a third of it to Northern Oil and Gas, which is a non-op company. And I really like the fact that those two companies that have great management teams have formed a area of joint interest, they call it. And they're going to focus on making acquisitions over in Southeast New Mexico in the Delaware Basin. And Earthstone's going to be the operator. And both of those guys have access to a lot of capital, and they look really good. Let's see. I think Comstock's making a little acquisition. You got
Chevron
Vital
bought.
Energy. Vital Energy is Vital Energy is one of the most profitable companies on a per share basis that I follow, and they almost get like no coverage. And they're making two relatively small acquisitions. They're going to increase their production by about 15,000 barrels a day.
And I think Chevron also in the last couple months just bought a producer in Colorado. So they didn't go in the Permian Basin because they already have a lot of production in the Permian Basin. So they went and bought some production out of a producer, another shale basin in Colorado.
Yeah, the DJ Basin. They bought PDC Energy, which was one of my favorite companies. Now it's going into Chevron. It's kind of a stock deal. So they're getting a combination of cash plus stock, the PDC Energy guys. But that's going to make Chevron one of the largest producers in the DJ Basin as well. And the DJ Basin's got very good economics. I think a lot of people are worried about investing in Colorado. It's run by Democrats. They think it's got geopolitical risk, but Colorado's always been very friendly to the oil and gas industry just because they get so much of their state's revenues come from that industry.
And it sounds similar to Alaska too.
Right. Yeah.
But when my day job, when I was an oil analyst, if I remember correctly, back in 2013, Magellan Partners was one of those master limited partnership companies, and it would always underperform. So you'd run the valuation metrics, and it would always look cheap, and it would always perform. And all the when I was writing for a larger paid newsletter company, all the people would always complain. So it looks like One Oak ran the valuation metrics there and said, well, they have pretty good assets, but the company's just not performing. So we're going to go buy the assets at a cheap valuation. We're going to try to fix things.
Yeah, they're actually buying the partnership. So they're buying the MLP units, and it will become a wholly owned subsidiary of One Oak, but it'll all be consolidated in One Oak's reporting. It creates a very large company, and One Oak is rock solid. One Oak is like a company that's over 100 years old. It's a very old company, and very, very well respected in Tulsa and in all of Oklahoma.
Is that one of your favorite dividend stocks?
Yeah, it's in my high yield income portfolio.
Now, U.S. Treasury yields are relatively high, so are money market funds. So people can, quote unquote, get a risk-free, almost 5% yield there. Are there dividend pipeline plays that you think are relatively safe that have comparable yields to U.S. Treasuries?
Yeah, the two that I like in addition to One Oak and is Plains All American Pipeline. Now, it is an MLP. PAA is an MLP. But you can buy the general partner, which is a C Corp, and it trades as PAGP, and it pays an identical dividend. The current yield is about 7.7%, but they have publicly said they are going to start raising their dividends until they get to a certain percentage of distributable cash flow, and they want to raise a dividend like 8% per year, to an additional 8% of what they're paying now, and do that until they get to a certain level. And based on my forecast, they're going to increase their dividends at least 3 years in a row until they get to that level. And one reason is because their capital expenditures, they spent a lot of money on new pipelines and stuff getting into the Permian Basin over the last couple of years. Those deals are now done. Those pipelines are now online. So they've got increased revenue and very little capex. So if you take their cash flow from operations less their maintenance capital, they have a whole bunch of distributable cash flow. So I think they're going to raise their dividends by quite a bit. Could be starting as early this quarter. Another midstream company I like, it's much smaller, but it's Antero Midstream Corp. It is a C Corp. It trades as AM. It has a yield of 8.4% the last time I looked, and its growth is tied to the growth of its parent company, which is Antero Resources. Antero Resources is a gas company, but also gets about 30-40% of its revenues from the sale of natural gas liquids. It's one of the largest NGL producers in North America.
So for the listeners who are not familiar, master limited partnerships versus the C Corp, if you buy units of a master limited partnership, you have to file with your tax attorney to pay the government. You have to pay you have to file a K1, excuse me.
Well, they send you a K1. So you got to wait until you get that K1 before you can finish your tax return. Some people don't like that. And then there's also, you can only
my
have
CPA. Yeah, my CPA didn't like that, and he had over 30 years experience. So it depends on your tax attorney if they have experience with master limited partnership investments. So even if they have a lot of years of experience filing corporate tax returns or other types of investments or personal tax returns, if they don't have experience with K1s, it's going to be a big hassle for them.
Yeah, it's kind of a hassle. And then you got to keep track of your basis, because the good thing about MLPs is a lot of their distributions are tax-free, but they do lower your tax basis in the unit cost. I only have one. In our high yield income portfolio, I have 10 companies. The only one that's an MLP is in there is Blackstone Minerals. And the reason I have it in there, it has a 12% dividend yield currently. It's about 70% of its production on a BOE basis is natural gas, but about half of its revenues are liquid sales. It is virtually debt-free. It's one of the most conservative management teams I've ever seen. And during last year, they decided to pay off almost all their debt. It's virtually debt-free. I think their current assets exceed their total debt. So they don't have any debt service problems. And it looks like to me, they're going to be raising their distributions. So that's one to look at if you can handle MLP. I would just say it's a lot easier from a tax reporting standpoint to own an MLP in a taxable account. You don't really want to own MLPs in your IRA account because it can cause you some reporting problems. So I strongly suggest you order that, because basically you would be giving up the tax benefits if you own them in an IRA account. You don't want to own a tax shelter inside of a tax shelter, and that's what an IRA account is.
I remember back in, I think, 2013 or 2014, Kinder Morgan tried switching everything from a master limited partnership over to C Corporation, and they botched it really bad. And the shares collapsed, I think, 40 or 50% in a couple months. And these were conservative income investors, and everyone just was going bonkers, just annoying.
Yeah, I think they created a taxable event is what happened when they did that. Because I used to follow them, I don't follow them anymore. But yeah, a lot of the MLPs converted back to C corps.
As we wrap up the interview, I want to get your thoughts on the proposed merger between ExxonMobil and Pioneer Natural Resources. Do you think the large senior oil producers are going to try to make the same, not try, but might make the same mistakes like how ExxonMobil bought XTO Energy at the top of that bubble? Do you think there's going to be similar mistakes done in this cycle?
Well, the only reason I could see them going forward with that deal, and I really don't think it's going to happen. Pioneer doesn't need the money. Their balance sheet's in great shape. They have tremendous assets in the Permian Basin, which is why Exxon would want to take them over. So if ExxonMobil's board believes that oil's going to $100 a barrel, they might pay a premium for it, but it would take quite a premium. The stock is, I think it's slightly below $200 a share. My breakup value on PXD is $255. And I think Exxon would have to make in order to get the board's attention, I think they would have to make an offer of like $275 to get that company. Those rumors have really cooled down here. Now there's other ones. I mean, I think Diamondback would be a great target for them. That symbol's FANG, FANG. And then you go down to these second tier companies that are pure Permian Basin plays. Or I mean, Earthstone, PR, Permian Resources. Those are pure plays on the Permian Basin. And instead of buying one big Pioneer, why not buy two or three of these second tier companies? So they're all takeover targets at the right price. That's for sure.
I think Chevron has done some smart moves. They haven't done the big splash acquisitions the last couple of years, but they bought like some really good natural gas assets, I think in Israel and Europe a few years ago. And then they just did this Colorado deal. Those are not massive deals, but over the long term, they're smart, sound deals, and they're not too big.
Well, it's just like EOG, about 6 or 8 months ago, made an announcement that they were making a pretty big investment in the Appalachia Basin. And, so that tells you they believe natural gas prices are in a couple of years are going to be a hell of a lot higher. And so do I. I think once we get past mid 2024, you're going to see the gas price move back to at least $5, I think, for 2025. And when we get by 2027, the U.S. is going to double their export capacity from 20 BCF a day to 40 BCF a day. I've got a chart on that if anybody wants to see my last podcast. And I believe then our natural gas price will move toward the European or international price, which is like $12 an MCF today. I don't think we get to the 1/6 of the price of oil parity on energy content, but I think we could get to 1/10 the price of oil could end up being our base price. It may be 4 or 5 years from now, but I think that's going to happen once we have that much access to the international market.
Well, you have the Freeport liquefied natural gas facility.
Yep.
I think it's back online fully. And then you have a number of other facilities that are going to come back online. I know that Tellurian, because of interest rates being so high, and Tellurian's a small cap, they couldn't use any debt to continue the rest of the construction of their liquefied natural gas export facility. And I think they said they were going to have to double their share count with equity share dilution. But normally what those small cap companies do is they do the equity dilution now, and then they do a reverse stock split later. But if interest rates do come back down, I think they'll switch back to debt financing later on.
Yeah. And several of the large LNG facilities are also going to add more capacity in the next 3 or 4 years. So it's not just new LNG export facilities. There's 3 or 4 existing ones that are going to add quite a bit more capacity.
And that's good because maybe then China will stop using as much coal, because I think in 2022, the average person doesn't know this, and it was kept under wraps because China is promoting like wind, solar, biofuels, how they're switching to green energy. But actually in 2022, Dan, they actually permitted 2 new coal-fired power plants per week.
I know, it's insane. And the one thing that I try to remind people later is all the time is another upside for natural gas. It gets very little talk because of all this EV stuff is the internal combustion engines actually run very well on compressed natural gas. Some of your listeners may remember that 5 or 6 years ago, remember all this talk about CNG, compressed natural gas, was going to be used for school buses and, Amazon trucks and all this stuff. They run great. They actually run better on compressed natural gas.
Well, you have metro buses in the city, and many different cities run on compressed natural gas. But I think Royal Dutch Shell was actually working on test gas stations, switching it over to compressed natural gas. They made a couple of them, but they never actually did the full switch.
Yeah, I had a small public company that was presented to us once. It's called CNG America. This is like 5 years ago. And they were going to work with the trucking companies to put compressed natural gas stations all along some of the major interstates, because what comes first, the delivery, chicken or the egg kind of thing. You got to have the delivery system before the trucking companies will pay to convert their vehicles to CNG. But if you get like diesel prices go high enough and there's abundant natural gas in this country, and believe me, we have got 100 years of natural gas reserve. It's the thing that's going to save us if we ever really do run out of oil. So we're lucky to have the gas reserves and the delivery system that we have in the United States.
I remember that small cap. I think there was a couple other companies too, and they had pretty good business models, but I guess they couldn't get funding to get all the projects moved forward. Yeah,
actually, I saw some statistics that if you go east of the Rockies, like 90% of all filling stations are within 5 miles of a gas pipeline. So it would be easy to hook them up. Just run a little line to all the filling stations. And, I would rather see us as a country, as a government, let's subsidize that build out instead of trying to build 1 million charging stations that are going to bring down the grid, for God's sake. Why not build that out and push that? Because I guarantee you, if you would convert half of our 18-wheelers to run on compressed natural gas, all that, work east of the Mississippi, which is where most of us live, if they would do that, I think you'd significantly lower oil demand. I mean, probably take 2 or 3 million barrels a day out of our demand. So.
Don't get me started on how much of the funds are wasted on these infrastructure bills. I mean, like they say,
it's insane.
It's all press. It's all puff pieces and press releases and Potemkin Village type of stuff, and then the funds are just stolen or wasted.
Yeah, I wonder how much is ending up in individuals' bank accounts. That's what I'm worried about more than anything.
Or insiders here in the DC metro area, they have friends and family members who are on the board of directors of a green energy company, and then someone in Congress, wink, wink, nod, nod, gets the Department of Energy or someone else to funnel unbidded contract to that green energy company. The shares go up a lot on hype, and then the insiders at those companies cash out their shares for enormous short-term profits, and then there's no real actual company that actually solves or fixes anything.
Yeah, get ahead in government. You create a fear, then you throw a whole bunch of money at it. And we're doing it again and again.
Well, ESG is the energy spending grift. I mean, I'm in favor if you actually want to have efficient energy. I mean, they should be switching to nuclear power. They should be doing common sense stuff with natural gas, with new pipelines and charging stations and natural gas storage tanks, so it's not flared off. They're not doing any of this stuff.
Yeah, the only solution that will actually, really lower carbon emissions is that we should be building a lot more nukes, but no citizen group wants a nuke in their backyard. Nobody wants to live near a nuclear power plant. So that's why they won't do it.
It also takes
even though I think they're very safe, even though I do think they're very safe.
Well, here in the United States, it also takes way too many years and way too much capital costs to get a nuclear power plant, a single one, permitted. So it takes over a decade, almost 15 years for permits. And then you're spending tens of millions of dollars on the permitting fees with the different regulatory agencies at different levels of government. And then you're spending over $1 billion to build a nuclear power plant. And that is almost never on time and on budget. So you're spending billions of dollars in extra costs, and the payback, the capital payback is your returns. You're waiting 2 decades for any type of return. So the average investor is not going to make that type of investment.
Yeah. Well, I mean, the good thing is natural gas fired power plants, we can build them quickly and they're reliable, and we've got the supply. So that's the bridge fuel. And that's really why I'm still very bullish on natural gas, even though the prices have pulled back here recently. I think we're going to call back. Gas will call back to over $3. It's already the strip. When you look at the strip prices for the fourth quarter, we're all well over $3 now in the next winter. And and once we get more of these LNG export facilities online, I think it'll hold up in threes. And then you get to 2025, and I'm thinking. I looked at Raymond James the other day. Their gas price forecast for 2025 is $5 an MMBTU.
What do you mean by, for our listeners out there who aren't familiar with strip, what do you mean by strip?
Well, the NYMEX strip price. The thing you see quoted in the news every day for the oil and gas price is the front month NYMEX futures contract. So right now, the August contract for delivery in August is what you see for the windfall profit tax or the West Texas Intermediate price, and for the Henry Hub delivery spot price. So Henry Hub is where you settle NYMEX futures contracts, and Oklahoma is where Cushing, Oklahoma is where they physically settle the NYMEX oil contracts.
If I remember correctly, isn't the natural gas futures, we talked about this, I think, in the last interview a couple of months ago, the natural gas futures a couple of years from now are substantially higher than the current.
Even for the end of 2024, they're like $4. You can lock in $4 gas price for the fourth quarter of 2024 today, if you wanted to.
So last question before I let you go. If the oil price in the short term, the West Texas Intermediate, the oil futures contract does go, say, below $65 or $60 a barrel, do you expect then OPEC to just sit back, or do you expect OPEC to actually announce further production cuts?
I don't think they'll have to announce further production cuts. I think when the reality sets in and we start seeing OECD and U.S. inventories continue to fall, you're going to get higher oil prices. I just don't see it happening. The only way that would happen is if we had a significant recession, and I just don't see it happening. Maybe a little mild recession in Europe or something. I just don't. I think we're past a recession in the U.S. Maybe it's just me, but I don't see it.
Well, even in recessions, I mean, if you go back and look at the data from 2008, now I think oil and gasoline demand, it didn't drop that much. So the one outlier,
it doesn't. Recessions do not reduce oil and gas demand that much.
I think it was only 2 or 3% drop in the actual demand. Now then it
bounces right back, and then as soon as the economy kind of recovers, bounces right back to the long-term line. Even after COVID, even after the big cut down of COVID, once we got to the end of 2022, we were back to the long-term demand curve, because demand is tied to the Earth's population more than anything else.
And oil is used to move goods and food supply and plastics, and so many other things are using oil or petroleum products. The other part of this is like the outlier is 2020. So the only reason demand collapsed was because politicians literally had to shut down the economy, and then once they started reopening things, demand returned pretty quickly. Yeah,
it bounced it totally a V shape. When oil quote went negative in the futures market, in the real world it dipped back to $12. So by the end of April 2020, it hit $12. Once you were in the first week of June, it was at $40. It came right back. It sat there at 40, and the companies were able to survive it at $40 oil for a good 6 or 8 months. But then it by the end of 2021, we were already back to, $60, $75 oil by then. This recent pullback on oil prices is all because of fear of recession. I'm telling you, they're just beating that drum like crazy.
So Precision Drilling, which is one of the smaller oil service companies, they said that they're actually going to be moving rigs to Canada and they expect production increases there. Are there any low-cost Canadian producers that you think are going to be able to generate free cash flow and actually grow their business in this environment?
Oh, yeah. I tell you, some of these Canadian juniors that I love, Hemisphere Energy, In Play Oil, Surge Energy, and they all pay. Those 3 companies have dividend yield over 7%. Hemisphere and In Play are virtually debt-free. In Play pays monthly dividends. Hemisphere pays quarterly dividends. I love those 2 companies. Their management is super conservative. They've used their free cash flow to pay off almost all their debt, and they are focused on generating free cash flow, and they're going to do it. Now, Hemisphere is a pure play on oil. All their revenues come from oil sales. In Play Oil has more of a balanced, about 40% oil, 20% NGLs or whatever, but probably 70% of their revenues come from liquid sales, so they're okay. I also like let's see. Well, I like Surge. Now, Surge is the largest of the 3. They pay monthly dividends. Their production is about 25,000 barrels a day, pretty decent sized company. And they've got a lot of running room. And you've heard about the Canadian fires up there, having some of these companies had to shut in. In Play Oil had to shut in a little bit of their oil, but it's back online. So I don't think Surge had to shut in any production because their main production is down in southern Saskatchewan. It wasn't where the smoke got really bad. So I like those 3 quite a bit.
And I think with the last examples you just mentioned, I think the oil industry is one of the only industries out there where the valuations are cheap, the dividend yields are high, and the companies have paid off a lot of their net debt over the last couple of years.
Yeah, I saw a chart today that said the upstream oil and gas industry has the highest free tax yield of any other sector, even at today's prices.
There's companies.
No other sector comes close to it.
Well, there's companies like Chevron and Suncor and Petrobras that have really good free cash flow yields.
Oh yeah, tons of free cash flow for you. Yeah, it's really good times. I mean, people don't. I think there's a paradigm that they think all these public companies are going to go out of business in 5 or 7 years because we're going to have so many EVs. I think there's nothing further from the truth.
Well, it's what the narrative is in public versus what these countries and the consumers actually doing. So you have like the Paris Climate Accords and the Davos crowd and the Western countries that are focused on electric vehicles and ESG policies. The rest of the world, they might pay that lip service, but with their actual behavior, China's opening up new coal-fired power plants. Other countries are announcing publicly we're building these giant liquefied natural gas import facilities. So that type of behavior does not show that oil and natural gas are being phased out.
Yeah, China and India, the largest population in the world in those 2 countries, their citizens are begging for affordable and reliable energy to improve their standard of living. And that's what their governments have to focus on. They can't get into this magical, mystical, windmills and solar panels are going to solve all of our energy problems. That is not going to happen, especially in those countries that have vastly, citizenry that is in energy poverty. They're begging for more energy.
Well, China's exempt from the Paris Climate Accords anyway.
Yeah, they're not going to go to those meetings anymore. I think some of the European countries will stop showing up.
So, Dan, you're a wealth of information on oil and natural gas. If my listeners want to take a look at the Energy Prospectus Group and what it's about, how do they do so?
Yeah, you could just go to Energy Prospectus at .com. And if you want to join, send an email to Energy's Prospectus, one word, Energy Prospectus @gmail.com. That'll go to Sabrina Jones. She's a nice lady that handles our member services. Tell her you heard about us on Jason's show. and she'll give you a promo code for $100 off your first year of membership. The membership usually costs $350 a year. You'll get in $250 for the first year. If I don't give you at least one good idea that makes $250 for you, then I've done something wrong. I think our three model portfolios, we follow like 36 companies, I think, in those, and they're all going to be profitable in the second half of the year. They all look really good, and some of them pay really good dividends.
Okay, so those three model portfolios, you have the Sweet 16, you have the income one, and is the other one like a small cap growth?
Yeah, it's small cap growth. And on some of those, we're up 500 or 600% on some of those, because my goal is finding these little companies before the Wall Street gang figures them out, and the ones that are going to be real profitable in the future.
I think where Big Oil's headed now is they're investing heavily in deep water in Guyana and Suriname. That appears to be the growth play outside the United States and Canada, at least.
Yeah,